wealthbranch.com.
Dividend growth stocks. In an article in the White Investment Research website by Stephen Mozzi titled, "This One Dividend Investing Strategy Destroys the Rest," they reviewed a backtesting study by Ned Davis Research. In this study, we find out how excellent dividend growth stocks are. Ned Davis Research analyzed the S&P 500 stocks covering the years 1972 through 2016. Ned Davis Research divided the companies into two groups, dividend payers and dividend non-payers, based on the company's dividend policy over the previous 12 months. The dividend payers were then segregated into three subgroups based on their previous 12 months of dividends. They were segregated into dividend growers and initiators, no-change dividend payers, and dividend cutters and eliminators. The companies remained in their respective groups for the next 12 months or until a change in dividend policy took place. Ned Davis Research then compared the wealth outcomes from the different groups. The outcomes are contrasting and stark. Investing $100 in the dividend growth members of the S&P 500 would have produced an ending value of $6,973. Dividend payers, a mixture of dividend growers and constant payers, would have produced the next best ending wealth at $5,015. The dividend non-payers and the dividend cutters and eliminators reside at the bottom of the totem. Had you invested your $100 in companies that never paid a dividend, your $100 would have grown to only $289 over 44 years. Had you been so unfortunate to invest only in the dividend cutters and eliminators, you would have done better storing your $100 in a coffee can. The dividend cutters and eliminators turned $100 into $82 over 44 years. Ultimately, there are two key takeaways we can use when looking for stocks. The dividend growers produced the highest returns while displaying the lowest priced volatility. The dividend growers were less volatile than an equally weighted investment in the S&P 500. Consistent dividend payers were also less volatile than the S&P 500. The dividend cutters and eliminators not only produced a loss over the holding period, they displayed high price volatility. They were 25% more volatile than the S&P 500. This is no surprise. When a dividend is cut or eliminated, the share price frequently falls off a cliff.